Hello. Today we'll be looking at investment appraisal, and that's section D of your syllabus. I know we've dealt with section A, we've dealt with section B, we've dealt with section C, and we've dealt with section E. A and B are the introductory section. C is working capital, D is investment appraiser, and E is the business finance, which we've just concluded in my last video. I believe all these sections are very comfortable for you, and if not, please send me messages. A lot of you have been reaching out to me and I've been helping out. I'm always here to support you. Now, you are finance managers, and remember, there are major objectives why you are being recruited. Three objectives why you have been hired to be a finance manager. And that is the key foundation of this paper, that for every finance manager, you must be able to make a funding decision. So you have been recruited to make funding decision for the company. You have been recruited to make investment decision for the company, and likewise, policy on dividend. These three objectives are the main reasons why you are a finance manager, because companies are not able to take these decisions by themselves without your assistance. So if they ask you what are the major objectives of finance manager, those are the three objectives. Or they might also ask you in this way: what are the key decisions taken by finance managers? It's funding decision, investment decision, or policy on dividend. Funding decision is also the same thing as financing decision, but our focus today and for the next few videos we'll be doing is on investment decision. Remember, we have concluded funding decision in section E that we just concluded. And now we are focusing on how to make investment decision. And that is what investment appraisal is all about. Why do we have to do investment appraisal? Why is it important? Remember, you have sourced for fund in funding decision, but you need to use that fund optimally. You need to use the fund such that the shareholders are able to get returns, or they are able to increase their wealth. And remember this popular formula. We said asset can be financed with liability and equity. These are the two major sources of capital. But this asset that we are talking about can be grouped into two types. We have the current asset and we have the non-current asset. Current asset, we've dealt with that when we handled section C on working capital. But for non-current asset, what we'll be looking at is the investment appraiser. That is the relevant one. That is the investment that we are talking about. Is the investment we make in non-current assets, and that is why we need to appraise such opportunities to be sure that they are good investment. And that is what investment appraiser is all about. It's about checking if spending money on this particular non-current asset will generate return for the company, but not just any return. It has to be a return that is worth it. And how do you know that this return is worth it for the company? Then you need to remember your knowledge on cost of capital, on cost of fund, because you must have used fund to invest in non-current asset. So if the return of that investment is not enough to cover your cost of fund, then that is a bad investment. So an investment is only good when the return on that investment is greater than the cost of fund. Take for instance, investment has a return of 6%. And let's say you have cost of capital. The cost of fund, because remember I said before you can invest in anything, you need funds. So you will have sourced that fund, whether it's equity or liability, and either of them comes at the cost. So if the cost of that fund is, take for instance, something that is around 8%, then this is a bad investment because the return is just 6%. So you invest 100, you get 106. but you use fund of 100, which comes at a cost of 8%. So by the time you pay 8% interest, the cost is 108. So 108 generates 106. Bad investment. So it's not just any return that makes sense, but it has to be a return that is worth much more than the cost of fund. And that is the basic concept that we'll be using in investment appraisal. So we will be looking at investment appraisal in different forms, which is by different methods. So there are different ways to carry that, because there is not just one way. This looks quite simple, but there are some difficult, a bit complicated methods that we need to adopt, and which you will also learn. So I'll quickly go into those methods that we use to appraise investment. The way I will talk about it is two groups. So usually you have the basic method, and you have the discounting cash flow method. I like to group it like that because there are different methods, and somehow the way I want us to approach them is good we have them grouped together, because what I'm going to be discussing for each of these groups will be similar, because the foundation is similar for each group. For discounting cash flow method, we'll be using cash flows and we'll be calculating discounted cash flows, which means present values. And for basic method, we're not going to be discounting anything. So usually the basic method does not require us to calculate any discounting, and the two methods we'll be looking at for basic method is payback method and the ROCE, which is also called the accounting rate of return. And please, the ROCE I'm talking about here is not the historical ROCE that you will see in ratio analysis. That is for past analysis. This ROCE here is ROCE for the future, for potential investment that has not been taken. And that is why most times your questions will not call it ROCE, they will call it accounting rate of return. But if you call it ROCE and you can see that what you are being asked to assess is a potential investment, then you know that it's accounting rate of return, because there are different formulas, and we'll look into that as well. So please take note. And for discounting cash flow methods, we'll look at the net present value method, and we'll look at internal rate of return. And likewise, there's a third one which is called the discounting payback period, which we'll also look into. The discounting payback period is similar to the payback period for the basic, but the difference is just that for the basic payback, we don't calculate discounted cash flow. So we use the raw cash flows as they are. But for discounting cash flow method, this discounted payback period method, we would use a present value method. We're going to calculate the present value of those cash flows, then calculate the discounted payback period. That's the way we're going to use it. So the way we're going to approach each of these methods, so we have about 5 methods of doing investment appraisal, and we'll look at each of them, all of them. In this video, I will complete basic. The next video, I'll go into the discounting cash flow method. So for the basic and for the discounting cash flow method, we'll use these 3 sections to understand it. The first one is I will tell you the meaning, how to calculate it, and I will talk about the advantages and disadvantages of each method, and likewise, we'll tell you the interpretation. Remember, in this paper, financial management paper, you must know how to interpret. It goes beyond just calculating, but the theoretical part of it is extremely as important, if not even more important. So you must know when your calculation or when your output is good or when it is bad. Good means that the company should go ahead and take the investment, and bad means the company cannot take the investment decision because it's not good for the shareholders. So we need to know how to use those methods to take decision. We need to know their meaning and their pros and cons. The first one we'll look at now is the payback method. And the payback method is looking at the payback period, which is about how long does it take for a company to recover the money they have invested. That is exactly what we're just talking about. If I spend $50 million today on a project, how long will it take for that project to return that cash back to me? So it's about risk. It's about liquidity. It's about getting my capital back. This method puts very little emphasis on return, but rather its emphasis is on liquidity, is on risk. So if you see a shareholder or an investor that is very risk averse, he will probably be looking at this method more than return, because he just wants his capital back. He doesn't want to lose his capital. So it's just the length of time it takes a company to recover its initial investment. So you can see, if you look at this example, say you have $50 million invested, and this investment will generate cash flow. Year 1, 10 million, year 2, 15 million, year 3, 25 million, and year 4, it will generate 40 million. Look at this. This investment looks good. However, the return is not the main thing that this method is looking at. The payback period, we will see, okay, in year 1, 10 million I will generate, so I'm left with 40 million out of 50. I will generate another 15 million. I'm left with 25 million to recover. Then year 3, I make another 25 million. Then by then I've made total of 50 million. And that is the 50 million I invested. And in that case, you say the payback period for this investment is 3 years. Because it took us 3 years to recover 50 million. And you can see that this method now has abandoned year 4 cash, even when huge cash flow is coming in year 4, 40 million. And we're going to solve questions to really see how this even works. Let me put up a question which we'll be using most times when we do all these methods. We'll use this particular question to analyze each method, and you will see. So company A is considering an investment opportunity in a project with the following initial cost and cash flows. And the initial cost is given, so which means we have to invest about $100 for this investment, and those are the cash flows that will come in every year, year 1 to year 5. And at the end of the project, which is year 5, the project or the equipment that we have will have a residual value of $5, which means we can still cover $5 after we've generated all those revenues. So how do we calculate the payback period for this investment? You start with the initial cost 100, which is negative. Year 1 will recover 50. We have a balance left of 50 to recover. Year 2 will make a revenue of about 40 again, which means by the end of year 2, we're going to have a balance of just 10 to recover. So it's making sense. We've not still recover everything. Let's see, year 3, we're going to recover. By year 3, we'll make another 30. So we only have 10 to recover our capital, but year 3 is even giving us so much cash flow of 30. So which means by year 3, we'll have broken even and recover all the capital that we invested. What does this mean? It means that our payback period is 2 years plus. But plus what? Plus how many months? Or you can also show it in a decimal, right? But how do you do that? There are 2 ways of doing it. If you want to show it in decimal, it means that since we need 10 and in year 3 we are making 30, it means that you assume that 30 is made proportionately over the year, which means from January to December, 30 is spread even. Then it means that 10 over 30 is the proportion of the month of the year that it takes us to make that 10. In that case, the payback period will be 2.3. So because it takes us 2 years plus 10 over 30 to make that recovery of $100. Another way you can explain it is to express it in months. Yeah, and remember, you are making $30 in 12 months, right? Which is 1 year, right? How many months will it take to make the 10? Because it's 10 that you want to recover, that you're interested in. It means it's going to take 10 multiplied by 12 months divided by 30, and that is 4 months. So another way to show your payback period is to say the payback period is 2 years and 4 months. However, so this is the meaning. Remember we said we'll talk about meaning of each method, we'll talk about interpretation of each method, and we'll talk about the disadvantages and advantages of each method. So now you understand what payback period is. Payback period is how long it takes to recover the initial cash invested. And to calculate it, you have to always take the initial output, the initial amount spent, which is the output, and start deducting your inflow until you recover the full output. Right. Now, let's talk about the other part. The meaning is done and clear, but we need to talk about the interpretation. If I ask you, 2 years and 4 months, is it good? Does it mean that the company should do the investment? You cannot answer. It doesn't make sense on its own. That is why, for you to be able to take a decision using the payback period method, you must get a comparable. It is extremely important. You need to compare that with something. And your comparable can be the company's policy, can be company's target, it can be company's prior year performance, it can be even benchmark to, say, a comparative company or industry average or peer company. So very important that there is a comparative to compare this with. Take for instance, if the policy of the company says we only go for investment that has a payback period of maximum of 2 years. If this is the policy, or if it's industry average, or if this is the target of the company, it means that this project that we just assessed now, that we just appraised, we will not be taking it, because the payback period for this project is 2 years and 4 months. And the company has said the maximum period they will be tolerating will be 2 years. So it means that is a no. So take note that the shorter the payback period, the better. Because the quicker you are able to recover your cash flow, which is the essence of the method. It's focusing on how quick investment is able to generate cash flows that can pay back or return back the initial amount that have been invested. So if payback period of the company is 2 years by policy, for this investment, like I said, it is a no. The investment will not be taken. Because like I said, the shorter, the better. Now, we've spoken about the meaning, we've spoken about the interpretation. Let's look at the advantages and disadvantages. Remember the structure that we're going to be using. So for advantages, as you can see, it's the easiest method. Out of all the 5 methods we'll be looking at, this is the easiest one. It's quite easy. It's easy to calculate. Likewise, easy to understand. And likewise, it deals with liquidity, which is good. Like you know that money, cash, is the blood of a company. If a company doesn't have cash flows, solvency will be a problem. Yeah. So because it's liquidity focused, is good, and that's an advantage. And likewise, like I said, it's easy, and also it is less manipulative because it doesn't require any estimate. It uses cash, and cash is cash. There's no manipulation there. It's not an estimate. It requires less manipulation, or it's difficult to manipulate, and that's a good advantage for the payback period. But the big disadvantage of this is the fact that it doesn't take into consideration what I call TMV, and that's time value of money. Let me write it in full so you understand what I'm talking about. I'm talking about time value of money. extremely important because you understand what time value of money is all about. Time value of money is saying that the $100 you have today is not the same as the $100 you have 20 years time, or even just next year. So if I buy a shirt for $100 today, that same shirt, if I'm going to buy it in 10 years time, I'm not going to be buying it for $100. Most likely that shirt will probably be going for maybe $200, because the value of $200 in 20 years time is probably the same as the value of $100 today. So that's time value of money. So this method doesn't take that into consideration. Another disadvantage is the fact that it is incomplete. The analysis is usually incomplete because the cash flows at the end of the payback period is usually neglected, which is what you also saw in this question we solved. By the time we got to year 3 that we are broken even, we did not check the year 4 cash flows. We just stopped there. And year 4 could be generating good cash flow that is extremely important even for decision making. However, this method would neglect that cash flow. So it uses incomplete cash flow analysis, which is not good. So that is very critical, but that's a disadvantage. So please take note. Advantage, it's easy, it focuses on cash flows, it's less manipulative. The disadvantages, the time value of money is not considered, which is common for the basic methods. The second method we'll be looking at as well have similar problem. This one has incomplete cash flow analysis, and likewise there is no return information. Sometimes shareholders might be interested in what is the return that I'm making. This method does not give you return information because it doesn't anyway look at it doesn't focus on complete analysis, so it doesn't give that return data. Very important. So that's that for payback period. The next one which we will look at, which is the second one, is the accounting rate of return. And like I said, the accounting rate of return is the same thing as return on capital employed for future analysis. It's not the same. Let me sound this one again. Not the same as the return on capital employed that you will use profit before interest and tax divided by capital employed. That is ratio analysis, and that focuses on historical data. For this one, we are not looking at historical data. We are only looking at the future data with a potential investment, with a future investment that has not been taken. So we want to take it, but before we take it, we want to calculate the likely accounting rate of return, the likely return on capital employed that this investment can give us. So simply put, accounting rate of return is the profit on potential investment. And what is the formula? So this particular one looks at the average profit and average investment, both of them. Like I said, it's a profit on investment, so which is same thing as the formula: average profit divided by average investment. And average profit is not just average profits in a confusing way. Let me make it simple and direct. We are looking at average annual profit. So you are going to annualize the profit. That is probably more explanatory. The profit needs to be annualized. So whatever profit that investment is given over the years, when you add it together, you divide it by the number of years that it used to produce that total profit, and that is annualized profit. So then you multiply by 100. So take, for instance, if you have an investment that gives a lot of profit every year, but by the time you add everything together over 5 years, say it gives 100, then that means the annualized, so the total profit over the life of investment is 100 over the 5 years, but the annualized profit is 100 over 5, and that will be 20. So that's just a way to put it. But like we've been doing, let's go back to our popular question and use the same question to deal with this annualized profit and average investment, so we can get our accounting rate of return. So average annual profit, like I said, for this particular question, we need to add up all the profit we are making, all the profit that has been coming every year, the cash inflows that we've been getting. Yeah. And that is given on the left side, which is the question. You can see year 1, year 2, year 3, 4, 5, all giving different cash flows. But when you add all of this together over 5 years, so you have 50, 40, 30, 25, and 20. All of that will give you, let me see, that's 90, 120, 145, 165. Right. Yeah, but you'll be wondering, oh, how did you get that? So remember, your cash inflows is what has been given, right? Which is your revenue. But your profit is revenue minus cost. Right. So revenue is what you have been given as the cash inflows, which is 50, 40, 30, 25, and 20, 165. So that is the revenue. Yeah, just I'm doing this. I'm breaking it down like this so that you avoid any form of confusion, because I don't want you to see cash inflows as profit. Cash inflows is the total cash coming in, but it's not the profit for you. Yeah, it's like a revenue. It's like you have sold something to a customer and he has paid you. That is not your profit. That is your cash inflow. Your profit will be what he paid you minus cost of sales. Right. So the same thing we want to do here. So the operating cost for this project is just the depreciation, because it's not going to be the capital expenditure that we spend. Remember, we spend capital expenditure of 100, but that is not our operating cost. If that asset will be fully used to the end of its life, then that can be the same, because by the time you depreciate it, it's fully depreciated into 100. But for this question, this asset is not fully depreciated to 0. It is depreciated to 5. So there's a residual value of 5, which means the only depreciation is 100 minus 5. And that's why I'm going to separate so that you can see the CAPEX, which is capital expenditure, is $100, and the OPEX, which is operating expenditure, that is the depreciation, is 95. And how do you get the 95? We subtract the residual value from the cost of the asset, because you don't depreciate residual value. That is deemed to be the value of the asset after use. And what is profit here? Profit, like you said, is revenue minus cost. And when you deduct that revenue from cost, that's 165 minus 95, and that gives $70. So you're making $70 for 5 years. So if you're going to make $70 for 5 years, what is the annualized profit? That is, what is equivalent of a 1-year profit? And that is the total profit divided by the total number of years. So in this case, we are making a total profit over 5 years of 70. And that will give us an annualized profit of 70 divided by 5. And that is $14. So this is the average profit. But remember, what we are interested in is not just the average profit. We are interested in the accounting rates of return. So which means we need to continue one step further by calculating the average investment. And how do you calculate average investment? Average investment is very simple. It's just your opening investment plus closing investment balance divided by 2. So for this question, the opening, which is what we paid initially of 100, and plus what we have at the end of the project, 5 years, we had 5 left as residual value, then we divide by 2. And that is 105 divided by 2, which is equals to 52.5. So now we know the average investment is 52.5. The average profit is $14. Then our accounting rate of return is 14 divided by 52.5. And that gives us, okay, we multiply by 100, because we're going to represent in percentage. And that will give us 26. We pressed on calculator and just check it quickly. give 26.7%. So that is accounting rate of return. So now you know the meaning of accounting rate of return. Like we said, it is the return on investment. However, is the average profit divided average annual profit divided by average investment. But just like you see, I said for the payback period, on its own, it doesn't give any interpretation. So you need to know the interpretation. How do we interpret it? We need to get a comparable. And the comparable, similar to what we had before, is that we use the company policy or we benchmark with industry or with a peer company. Or even, like we said, also maybe historical performance of the company. If the if the accounting rate of return last year was 20% and this year is 26.7, you can compare and say, yeah, I think this investment will be better for us because what we're doing last year or what we assessed last year was not even as good as what we're going to get in this investment. So for this one, the higher the better, unlike the payback period, which is the shorter the better. So the higher the return here, the better we want. So take for instance, if a company has a target or a policy of 25%, and this investment is giving us a 26.7, then that's a yes. It means that we have to do the investment because we said the minimum we will take is 25%, but our project is giving us accounting rate of return of 26.7. So because it's higher than our target, it's higher than the policy, then it is a good option. It's a good investment choice, and we should go for it. We are happy to go for it. And that is the way decision is being taken for accounting rate of return. So like I said, just similar to payback period, you must get the comparable. The figure on its own does not give any interpretation. The figure on its own does not help you to take a decision. You can only take a decision when you compare with something else. So lastly, let's look at the advantages and disadvantages. And just like the payback period, the advantage, the first one, is the fact that it's easy to calculate. Yeah, it's very also easy to calculate. And also, it has a profit element. Unlike payback period that doesn't show any profit. This one looks at the whole cash flow, the entire cash flow. So it has profit information because it's able to go through from the beginning to the end of the life of that project. All the cash flows are coming in. So, which is a good one. Or disadvantage, the popular one, which is common for all the methods that are basic, is the fact that they don't take into consideration time value of money. TVM, time value of money. Please take note of this disadvantage because it's very common, and in exams you can be asked disadvantage of method. They might give you a question asking you to assess that investment using all these methods we are looking at. Then after they tell you which one is better or which is the disadvantage of the particular method. Very important to take note of all of this. So that is accounting rate of return, and that is how it's being calculated. You've seen how it's been interpreted as well, and likewise we've seen the advantages and disadvantages. This is where I will stop this particular video. In the next video I'll be talking about something different, which is the discounted cash flow method, a bit more complicated than these ones. And please make sure you subscribe, like the video, switch on your notifications so you can know when I post new videos. A lot of new videos will be coming in the next few days. Please stay tuned, and see you in the next class. Yeah. Before I go, just remember, I need to note this down as well, because it uses profit information. Accounting manipulation is also possible, right? Very, very possible, because this profit involves the use of estimates like depreciation. If you use different methods of depreciation, you get different values. So it's possible a company is trying to use a method that gives a lower depreciation figure. And when your depreciation figure is low, your profit will be high. Yeah, so and likewise, if the company wants to hide profit, they can make depreciation to be high. So because you can play around depreciation value, it's a problem. And because of that, that makes manipulation possible, and that's a shortcoming of this particular method. Yeah, I just said I need to mention that as well. Very, very important. Okay, so we'll connect again in the next video. Thank you and bye.